Welcome back to segment 4. Segment 4 is trading and risk management. Now, risk management is one of those tricky topics because there's no right way to really cover this. It really comes down to your own risk tolerance and your trading style. What works for one trader may not work for another. And so in this video, what I wish to do is, I don't wish to regurgitate what we already see online on YouTube, the theoretical aspects of risk management. I'd like to give you more of a personal, practical approach as to how I manage risk and walk you through some of the scenarios in the ways I use my risk management when it comes to trade execution or positioning into trades myself. In previous videos, I've talked about the importance of expectancy. So basically knowing the edge behind your setups, understanding the expected value of each trade and being aware of the range of possible outcomes over time is so important. Because at the heart of good risk management is exactly knowing your expectancy, understanding how your average winners stack up against your losers, and being able to size up when the odds are truly in your favor. And so expectancy, if your expectancy is greater than 0, then you do have a profitable system. But if your expectancy is less than 0, then unfortunately you have a non-profitable system, and that's the reality. Now, it's something that we've covered in previous videos, and why really when you think about trading, it all comes down to what's your expectancy behind a given setup. But really, you could have a very good strategy where the expectancy is very positive. But then if that isn't encapsulated by very good risk management, then it really brings into question the expectancy of a trade setup or the expectancy of a strategy. Whereas the real issue is not so much the strategy, but it's your inability to manage risk effectively, which can then skew or give you the perception that, hang on a minute, I'd actually have a positive expectancy. So there really has to be a level of appreciation between what is genuinely a very good system that provides positive expectancy, but it has to be backed up by a very good foundational risk management framework. Edge without risk discipline is like a Ferrari with no brakes. You look great until you crash. And so at the end of the day, the more you're willing to risk, the higher the stakes become. And if you don't manage that correctly, it can seriously hurt your account. And I've been there myself many times where I've really tried to push my edge, where I've, eventually leading to me oversizing. Because on the back of a very good streak of trades, my confidence has gone up. So I'm trading on a level of confidence. And now I've increased my risk significantly. In the past, I've risked 7, 8, 9, 10, 12% on a trade. But what then happens is that when you take a significant loss, it really affects your ability mentally, because you then go back into your shell, you start sizing down, you lose that confidence. All the hard work of trading effectively and efficiently for the last several trades has gone to waste because of your inability to control your risk and control your emotions. So just remember, you're not trading to be entertained. You're here to compound an edge. That means protecting your capital, sizing intelligently, and only really sizing up when the probabilities are in your favor. And like I stated, risk management really helps to encapsulate your edge because it's about playing smarter when it comes to trading. It's ensuring your edge has room to play out. It allows for protection of your mental capital and gives you the ability to grow over time, because ultimately this game is all about survival. The reality of trading failure, 80 to 90% of traders fail. Just think about that. How many people come into this game and think they've got a real good crack at making it as a trader? It's a very difficult game. More often they blow up because they don't manage risk. It's not the market that takes them out, essentially. It's their own bad habits. And it comes down to risk management. I've been there. I've done it myself. I've blown accounts in the past. And the reason I blew those accounts simply was down to the fact that I was oversizing and taking on too much risk. And then all it takes is just one trade to be wrong, and you take a massive hit on your account. So really, like I said before, it's all about survival and giving yourself a chance to really thrive in this game. And when we look at some further statistics, most retail traders lose money within their first year. A study by AMF, over 89% of active traders were net losers over a 5-year period. IG Markets found that only about 10 to 15% of traders are consistently profitable, mostly due to proper risk management. And even at prop firms and hedge funds, capital preservation is rule number one. If you're down too much, you're out the door. Simple as that, really. There are no second chances. And trading is ruthless. There really are no second chances, because once you take a significant hit, it takes some serious effort to recover from that. So what are some of the most common risk management mistakes? By no means is this list exhaustive, but it's often down to a variation of risking too much per trade. Sometimes 5-10% instead of 0.5% to 3%. How many of you actually respect your maximum daily and weekly drawdown limits? Do you even have them defined? And revenge trading after a loss. So levels of psychology or trade psychology where you go on a tilt. And then ignoring your position sizing because you're not really calculating your position size required or how to structure the trade correctly, ensuring that you are within your risk limits. And obviously, how often, as part of revenge trading, do we see the common case of doubling down to make it back? You take a significant loss, you go in harder on the next trade, and you lose that as well. So we've talked about this in the previous videos when a trader goes into a death spiral and how it can really significantly impact their P&L to the downside. So by no means is this going to be an exhaustive risk management video. I will leave some other resources for you to watch at the end of this recording. But what I would like to do is give you an understanding of why risk management is the foundation of successful trading, giving you a high-level basic risk framework that you should be applying to your trading if you don't already have one. If you have one, great, but if you don't, then at the very minimal, you should have a basic level of a framework. And then thinking in probabilities and how to really structure trades from a risk to reward scenario. Obviously, with the risk to reward comes position sizing and calculating the risk per trade, and then looking at some of the more nuanced concepts such as Tom Dante's evolving R and dynamic risk management and sizing up, which is something that I've covered on the previous streams, and I think it's something that I will continue to cover with you guys over the streams during the next 2-3 weeks. And then finally, we'll wrap up on the importance of adapting risk management to different market conditions, especially based upon whether it's a range-bound environment, whether it's a trending environment, or whether it's a event-driven environment where we really see a heightened level of volatility. So those are some of the market conditions that you really have to take into consideration as a trader. So let's take a look at why risk management is the foundation of successful trading. Now, in terms of risk management, you have to think about your psychological risk. Unlike algorithmic systems, as a human trader, discretion trading really depends upon your decision making in real time, which is then influenced by your emotions, a level of fatigue or stress, and then you have cognitive biases such as confirmation bias. Overconfidence is one that I've just talked about. So without tight risk management, a single lapse in judgment can really lead to devastating losses that wipe out weeks, if not months, of your hard-earned gains. So what you can do is you can control risk, but not the outcome. Markets are inherently uncertain. Even the best setups fail. I have it when I'm setting up for a trade that looks like a high probable long at the range lows, and then I get stopped out and price breaks down. If it wasn't for good risk management, despite the fact that I've got a very good level of expectancy on the trade setup, I can at least control the amount of money I'm willing to lose on that given setup. So markets equal uncertainty, and the key thing is that a good risk management allows you to survive failed trades. No single trade can ruin your account, and that's so important, as opposed to how often do we see, on social media, traders that run up accounts significantly, and the moment the market turns to the downside, people have been liquidated. Big liquidations, huge losses. Okay, so you've got to stay in the game long enough to let your edge play out. And so another important aspect of having a very good risk management system is it allows you to manage your drawdowns more effectively. Because keeping your drawdown small, there's three very important aspects here. It allows you to build confidence because your losses are very small. It allows you to scale up safely because you know that over a large enough sample size of trades that your losses are very small in comparison to your winners. And it also reduces the recovery time. Recall how I stated in the past where I've risked 15 to 20% on a trade and I've not really respected my risk limit or stop limit, and I've taken a 30, 40, 50% loss. It happens. It's happened to us all. So there's no point in bullshitting that it's never happened, because it's part of the processes that we have to go through and experience that pain to learn from those emotions and how to become better traders. So managing risk really is about managing drawdown, which then directly impacts your ability to grow your account sustainably. And so if you can keep your drawdowns and losses very small, you are then in a better position, right? The very first thing that you need to do is to achieve a level of profitability, you've got to keep your losses relatively small. That's step number one. The minute you can start doing that consistently without taking those big dents, only then will you start seeing a level of profitability in your trading. And then you've got to repeat that for the next 100 trades. And so risk management really helps you to protect your edge. Note how I talked about risk management helps encapsulate your expected value or your expectancy. Because at the end of the day, as traders, myself included, we don't have a massive statistical edge, but you don't really need one either. You just need a very small edge to become successful or successfully profitable in this market. And so therefore we rely heavily upon trade execution, the timing of our execution, and then adapting to the market conditions. Because again, if you're risking too much per trade, then a small losing streak can create psychological pressure. And that pressure then erodes your discipline, leading to even bigger mistakes. And this is why risk management really helps to preserve your capital and your mental clarity. So you're establishing a level of consistency and longevity. And then the final point, elite traders, all the top traders have a very sound risk management system. They all have an appreciation of understanding their expected value and the probable range of outcomes on their trade setups, which then allows them to position accordingly and size dynamically, okay? Because I don't believe that trading is just about static position sizing and static risk to reward. Here's your entry, here's your stop, there's your take profit. And then the dynamic aspects of trading, where I believe that, entering a trade can be quite dynamic. You're looking to compound, you're looking to add size onto those winning trades. And equally, if price is very close to your take profit limit, but it breaks down, do you then round trip all that unrealized P&L and take a loss? Because I'm sure many of you experience that. So you have to adapt to what the market is telling you and what the market is showing you, and recalculating your ability to take profit or reduce risk when you are significantly in the money on a trade. All right, let's move on to the next aspect of this video. We're going to be covering some key concepts which every trader should have a level of appreciation for. The first one being is how much you are risking per trade. The second part being your reward to risk ratio, your RR, also known as the asymmetry behind a trade. And then the third part is your win rate, okay? What's your win rate, your risk to reward ratio, and your overall expectancy? And the key here is, look, when it comes to risk per trade, this is a non-negotiable. You should really know how much you're willing to risk per trade before you even enter the trade. If you recall the aspects of the performance process cycle that we covered in the previous videos, is the planning phase, the preparation behind the trade. I've shared the trade sheets with you. You should know exactly how much you're willing to lose per trade before you even enter the trade, okay? And as a general rule of thumb, especially for those of you who are trading, a new strategy, you're still trying to understand your game, I would recommend anywhere between 1 to 2% max risk of your capital per trade. Anything more on a strategy that you're not familiar with, or you're still trying to find your game, then I think you are essentially playing with fire. You have to remember survival comes first. And I keep talking about trading is all about survival. It's about risk management first. And then you can think about the reward along with the expectancy of a given trade setup or strategy. So you can't really build consistency if you're always recovering from deep drawdowns. And for that reason, I always keep saying that use sensible risk management, risking even between 0.5 to 1 to 2%, sometimes 3%. You give yourself a real chance of surviving in this game. And the key caveat to this is the market isn't going anywhere. You don't need to hit a home run. You just need to stay in the game long enough. The second part is the reward to risk ratio, often known as RR, or what some people call R. Okay, it's your asymmetry. You're not in this game to be right. No trader is right 100% of the time, and that's absolutely fine. Generally, as a rule of thumb, I look for a minimum 2 to 1, okay? 2 to 1 hour setups or a 2-hour setup. And good traders can push that even higher when they've really refined upon their trade execution with some really logical tight stops, but not tight stops for the sake of trying to push more size or get more notional size on the trade. But there's a real process behind that stop placement to help you define the structure of the trade, the position sizing of the trade, and how much you're willing to risk in terms of your account, purely through understanding your game from a proven process, the ability to know your expectancy behind that setup, and then putting on the trade. So when you structure risk properly, you can be wrong a lot and still make some serious money. Now, far too many traders, chase a high win rate. I've done it in the past where I'm always trying to look for 70, 80, 90%. But the reality is that's your ego. It's your desire to be right all of the time. Nowadays, my average win rate is hovering at that 40 to 45% level. But I can afford to operate at that lower win rate because my losses are very, very small, which I've kind of shared how I cut my losses very quickly. But what really matters is your expectancy here, the quality of your edge over time. So you can be right 35% of the time and you can still have a very good, profitable trading career. And so when it comes to expectancy, if that number is positive, you've got a scalable edge. If that's negative, you're not in business. You don't have an edge. You're just pressing buttons for the sake of it. So you're a risk manager first, a trader second. Know your numbers like your life depends on it, because in this game, it really does. So we've just discussed risk to reward ratios, how much to risk per trade, why it's important to understand your win rate, but having a low win rate isn't necessarily the end of your trading career. You can have a low win rate as long as your expectancy behind the trade is good. You have a positive expectancy, even if you're operating on 2.5, 3R per trade with a 35-40% win rate. You can have a very good trading career. So what does that mean? It means losing 60% of the time, but still being profitable, as opposed to winning 70-80% of the time, but being a losing trader because your expectancy is negative. And so we move on to position sizing, the multiplier or killer of your edge. Now, what is position sizing? Position sizing essentially allows you to establish how much capital you are allocating to a single trade. And so this is where position sizing is very important, because if you're sizing too small on some of your best setups, you're not really going to realize significant profits. And equally, if you're betting large on those trade setups where the expectancy is low, there's a good chance of you getting stopped out, or even if you don't respect your stop limits, you're going to take significant losses. And so you've really got to get the balance right when it comes to position sizing. And I know from experience that most account blowups do not happen because you've got a bad trading setup or a bad idea. It essentially comes down to neglecting your risk parameters, your risk framework, understanding when you should really be looking to get out of the trade. So what is position size? Position size is essentially the formula for this is your account capital multiplied by your risk per trade as a percentage divided by the dollar risk per share over the contract. So this is more applicable if you're trading CME futures. Say, for example, you're trading Bitcoin on CME futures where there is a certain notional size behind each contract. A slightly simpler way to think of this formula is account balance times by the risk percentage divided by the entry price minus the stop loss price. So your account capital is essentially your total trading capital. The risk per trade as a percentage is how much of your account are you actually willing to lose on a single trade, or how much are you willing to risk essentially? Is it 1 or 2% or 0.5%? And then the dollar risk per unit, the difference between your entry price and your stop loss in dollars per share of the dollar per contract. So now let's look at an example of position sizing. Now, before I proceed ahead with talking about this example, one of the key things that I use is a position size calculator. Now, it's something that I've coded up myself. I have my own software that I run and have on my desktop when I'm trading at the desk to quickly calculate the required number of contracts I need to open when I'm trading on futures. And so I really recommend you guys to figure out a way that makes sense to you, which allows you to quickly calculate your position size during the execution phase of a trade. Now, you find most exchanges do provide a position size calculator, as do many trading terminal software, but there are also websites out there which will allow you to calculate the position size on a given asset. Or, you could even use, for example, ChatGPT to really replicate something that's out there and run it locally on your own machine. Right, let's go through the trade contract. Right, let's go through the position sizing example or exercise that I've laid out in front of you. Hopefully we can do this in 60 seconds. It really shouldn't be any longer than it needs to be. Now, assuming that we have an account balance of $100,000, we wish to risk a static 1% per trade. And in this instance, we want to go long on Bitcoin. Our entry price is $80,000. We've defined our stop at some recent swing low or the previous swing low, and that's coming in at $79,500. The stop distance is $500. So 80,000 minus 79,500 gives us a stop distance of $500. The contract type is BTC USD perpetual. So now we need to calculate the actual Bitcoin position size required. The entry price is $80,000. I'm risking 1%. My stop loss is at 79,500. The stop distance is 500. Bitcoin size equals risk divided by stop. We're risking $1,000 divided by the stop distance, which is 500, therefore giving us, or required exposure needed is 2 Bitcoins. We then move on to what the notional position size is. The notional position size is 2 Bitcoin times by our entry price of $80,000, giving us a $160,000 notional size, okay? And then this is where the leverage aspects comes into this, right? Because leverage comes into play because assumedly, just say that you have a maximum account of $100,000. You don't really want to keep all that money on the exchange due to counterparty risk in case there's an exchange hack or the brokerage goes down, right? So you really want to keep a subset of your capital. But we'll just run with it in this instance. Now, using leverage, okay, assuming you're using 10x leverage, just because I'm using 10x leverage doesn't mean that I'm increasing the position size significantly or I'm really amping up the risk on the trade like a degenerate. Using leverage sensibly just allows you to reduce your counterparty risk for a given exchange. So now we have to calculate the required margin to operate or run this positional size. So our position size that we're running is $160,000 divided by 10, which is the leverage used. Therefore, it now equates to $16,000. So you only need a $16,000 margin requirement of your overall capital to open the trade. But notice that the overall risk still remains the same. You're still risking $1,000 with far less capital using leverage to still fulfill the notional size that you had intended. Okay, so that's really the main purpose of leverage, okay, is to reduce your counterparty risk and to put on the required size that you would like to put on, yet you're risking 1% of your account. And I've summarized this over here. What you can do with something like this is to take all these parameters, push them into ChatGPT and ask it to give you a calculator in Excel, or to generate a calculator so that you can work out your position sizing very quickly. That will tell you how much Bitcoin you need, what's the notional size, and basically what your margin requirements are if you wish to use leverage, whether you want to use 5x, 10x, 100x, whatever it is. It allows you to very quickly on the fly calculate the actual number of contracts required and the margin requirements around that. So the key thing to remember here is position size is a function of risk, not conviction. Now, position size depends on risk, not how confident you feel. And so you've got to really think back to when you're executing those trades. Are you trading and oversizing due to being overconfident? Or are you truly sticking to your process and your risk management framework? And therefore, you're trading the setup as to how it should be traded, okay, in terms of how much position size you're looking to run. Now, when structuring the trade with sizing, the key is not how certain you are about the trade's outcome, but how much you're really willing to risk losing if the trade goes against you. And so your position size should really be determined by two factors. The first factor is your risk per trade. What's the maximum dollar amount you're comfortable losing on a single trade? And this is something that I do from a psychological perspective. When I look at a trade setup and when I'm looking to execute the trade, I already know beforehand exactly how much money I'm willing to lose on that trade. And psychologically, mentally, it just helps me prepare for the adverse scenario that, okay, I could take a loss here. And then the second part is the stop distance. How far your stop loss price is from your entry price should be expressed in points or in dollars, okay? Whatever makes sense to you. So why does this approach work so well when it comes to position sizing as opposed to trading randomness or just sizing up for the sake of it? Because you don't really have anything systematic. It gives you a framework of consistency. So we talk about consistency. You are consistent in your losses. It keeps your potential loss fixed and consistent, regardless of how volatile the market is. And then you've got to think about automatic adjustment for volatility. When the volatility levels have increased, say for example, in a range, you can get away with a tighter stop at the range high, the range low. But when the environment shifts into a trending environment, you may want to go for wider stops. And with wider stops, that means your position size will decrease accordingly, therefore reducing the probability of a large loss. In fact, I wrote an article about this, which I'll share. And so if you come over to the Substack under process, you'll see there was an article that I wrote here on the 7th of April, volatility, spreads, ATR, and risk. Give this a read because this is actually very important to understand and how you can use ATR as a volatility filter. Okay, and then points 3 and 4, prevents overexposure. And another way to think about position sizing is if you truly know your setups and you can get really tight on a trade, then it will allow you to really put on some significant size while still respecting your risk limits. And that's where sometimes pushing your edge really comes into the play, because not only are you looking to size up, but you've also really refined the level of risk remains constant, but the position size increases because you now have tighter stops. A slightly more advanced way to really size up on trades is something that we'll cover in another video or a separate video or during the live streams. I'll specifically cover how to really add to your winners and dynamically add to your trades And I think in terms of risk management, this really ties into trade execution nicely. And I think we'll save the examples of risk management with the trade execution video on how I go over the various nuanced aspects of position sizing dynamically, as opposed to covering it in this video, because I think it really serves better under the context of trade execution with risk management. So the next several slides are really about other considerations that you need to take on board. We'll start off with understanding your capital and risk appetite. You need to define and understand your trading capital and setting realistic expectations around them. Now, let's just say that, your entire net worth is $100,000. Do you really want to be keeping $100,000 on the exchange? My honest answer would be no, not financial advice. I would only be looking to keep a subset of my capital on a futures exchange, maybe 10, 15% when it makes sense, okay? So the second part is you have to really then determine your risk tolerance. How much capital can you afford to lose? Again, this ties in with the very first question that I asked. Then you've got to understand the position size and basics, which we've covered today, and why this is the key to preserving your capital. I generally set a minimum risk of 1 to 2% per trade. It's only when price comes in to these high time frame inflection points at the extremes of a range where I really believe I can run a position for several weeks, will I then start thinking about having wider stops, but running with 3, 4, 5, 6%, exposure on a trade. But I'm building up that exposure. I'm not just opening a trade with 3, 4% exposure. I'm waiting for the trade to be on side. And then if it makes logical sense, I will then try to structure a separate trade profile or a separate trade for that same market, which then allows me to add more size accordingly, whether it's on the same account or whether it's on the sub account. And the importance of all of this is that you have to calculate your risk before entering a trade, because if you're not doing that beforehand, then you really are likely at one point in the future going to suffer from significant losses on a trade setup, because you're part of your process, part of your system, part of your risk management is structuring the trade, is understanding exactly how much exposure that trade should have and how much you're willing to lose for that trade. Not some arbitrary number because price is coming to this level that you've been waiting for, you're really going to go for it. That's not really managing your risk effectively. That's a level of overconfidence. That's a level of greed kicking in. So you really have to curb your emotions. So calculating and managing risk on each trade, you have to know your entry, you have to know your stop loss, you know what your target price is, and that then allows you to quantify your risk. And if you're trading something like CME futures or some other products, then you really have to understand the margin requirements for trading those products, and you have to understand the dollar risk per contract or per share. And so this is again where you really have to use an effective position size calculator to really help you structure the trade and position accordingly as per the margin requirements and contract requirements on a futures account. Now, as a rule of thumb, like I said before, I generally aim for a 2R setup. Sometimes I try and squeeze a 3R, but I use a principle called evolving R, which is something that I will cover on the coming streams and over the coming videos as to how I dynamically manage my risk. I don't have a static entry. I don't have a static target, okay? As price develops, new information comes in, and therefore, for me, certainly for me, I have to dynamically adapt, taking profit or reducing position size if the trade is going against me, or whether I entirely cut the position, despite the fact I've not taken a 1 hour loss. I may have only taken a half an hour loss. This, for me, is being dynamic, is being fluid, and the extremes of losing a trade or being stopped out completely at a hard stop is my maximum adverse scenario, where I'm willing to take a -1 hour loss. I'm willing to risk losing that 1%. Daily and weekly risk limits. I think this is one aspect which many people overlook, and by ignoring this, it's very easy to go on a tilt. And I only really started seeing changes in my own trading when I had predefined capped limits. For example, on a $100,000 account, I would have a daily stop limit of 2.5% and a weekly stop limit of 8%. If I breached the daily stop limit, that's it. I cannot trade for that day again, even though there may be a good setup. I need to go back to my process. I've got to review my trades. If I've truly followed my process and I've taken a 2.5% loss, then I need to review something. If I've lost 2.5% because I'm trading like an absolute twat, then I wasn't following my process, and I need to get back onto following my process. And it's the same applicable for the weekly limit. Generally, my weekly limit is between 6 to 8%, depending upon which trade account I'm trading. But again, it just allows me to stay in check with the market, keep level-headed, remain on top of my game without really going on a tilt. The minute I lose control of my daily and weekly drawdowns, the greater I'm likely to go on a tilt, and what should have been a 2.5-3% account loss quickly becomes a 20-30% account loss because I start revenge trading, or I'm trying to make it back in 1 week. So sometimes respect your risk limits. It's there to protect you. It's not there to prevent you or hold you back. It's there to help you survive so that you can come back into the market at a future date, and hopefully you can turn your losses into becoming profitable again at some future point in time. You also have to think about risk management in different market conditions. Again, I made a reference to the Substack article that I published. Please do go ahead and read that. I think that really covers using volatility, ATR, and understanding risk in these volatile regimes and how you can potentially position accordingly in those volatile regimes. And volatility is great. You know, many people freak out when they see an uptick in volatility. But for me, volatility is what I live for. As a trader, you want to see volatility. The reason why most people back out or step aside when markets are extremely volatile, it's because they don't have a risk management system for those volatile environments. But in my opinion, if you are on the right side of that volatility, you can hit some really big results. And it's not very often, you know, that the markets are extremely volatile. The markets are often grinding, just churning. You're making that 1 to 2% a week. You're losing 1 to 2% a week. But when there's a shift in volatility, they happen every so often, every few months, or every once a quarter. They're the opportunities that I look for to really start sizing up in my trades, really try to take advantage of the volatility of the spreads, the volatility of price, okay? And you can get some really good rotational trades in those environments as well. So risk management tools and techniques, you have to use stop orders or trailing stops or mental stops, manual stop alerts, whatever it is. You need to have some level of insurance or protection in place, okay? Whether you're away from the desk, whether you're running overnight positions, you need to have a stop in there at all times. I think it's very dangerous, and I think my biggest losses have come from times or periods where I wasn't running any losses, and before you know it, price has really ripped the other way, and you're then closing your trade for a potential 2, 3, 4, -4 R loss. What should have been a 1 R loss, 1-2% of your account, suddenly becomes 6, 7, 8%. And I guarantee you, this is probably the number one reason why many traders fail in this game, because they don't have any hard stop limits in place, which is there to protect you. Ultimately, you are gambling at that point if you are not trading with any stops. Another way to think about risk management is hedging. Again, this is something that I think is out of scope for this given video, but it's something that we will cover on the streams. And then you have to think about diversification across various instruments and timeframes. And most importantly, this is the only way you're going to grow is through journaling, effective journaling, reviewing your risk management process, having your risk management encapsulate your trade strategy, your trade setup, and it forms part of your process. Without risk management, you're not going to make it. It's as simple as that. So part of this mentorship, one thing I'd like you to think about is building a personal risk management plan. You need to really start off by writing a written risk management plan aligned with your style, whether you're a swing trader, a day trader, a positional trader, whether you're working full-time, part-time. Understand who you are. And we did this in the very first exercise when I asked you all to tell me, what are your goals? What are you looking to achieve? What type of trader do you want to become? And this certainly builds on top of that. And so one of the things that I've got is my trading manual, because in there I have defined what my risk is per trade, depending upon the setup. I know my max daily loss limit. I operate on a 2.5% max daily loss limit. Okay, my weekly max loss limit is -8%. And I know what my maximum position size is overall, assuming that I've got 2, 3, 4 trades on. I also need to be aware of the overall account risk. Okay, so it's not just per trade, but it's about the overall account. How much account risk are you currently running if you are running 3, 4, 5 positions? Okay, so you have to adjust accordingly, that if you wish to open up new positions whilst you already have some running positions, then you need to calculate what type of position size you can run on those new entries or prospective trades, such that you are still contained within your overall daily and weekly risk limits. Okay, and you've got to have the discipline to follow your plan consistently. Like I said, a good risk management system is key for a trader. You've got to know your entry, your stop, your loss, and then you can structure the trade and position sizing around that. Without that, you're not going to make it. Secondly, your risk management is part of your process. Your process is part of your overall trading performance, of which there are trade setups, there are trade strategies. Okay, your trade setups are not always going to win. You will get some losing trades, but your risk management is what protects you when you are going to or likely lose those trades. But in the final part in all of this is your nuance. Okay, I cannot give you my risk management framework and expect you to become profitable, nor can you expect to develop a risk management framework from me. It's very, very nuanced. It's nuanced upon your trade execution style, your mental discipline, your psychological discipline. Okay, we talked about psychology risk. We talked about keeping losses small. Everything we've discussed in this mentorship up to this segment and including this segment is building upon the non-technical aspects of trading, the foundations, okay? Not the clicking the trigger part, but everything you need to get to before you can start really seeing a shift in your performance as a trader. All right, so I'm going to wrap it up here as part of this introduction to risk management. I think there are some fantastic resources out there, and what I wanted to really achieve in this video was just my view and how I approach markets and how I manage risk. And certainly what I'd like to do as a continuation of this video is to go over some live examples. When I talk about trade setups on the up and coming streams, we'll talk about position sizing. We shall cover risk management. We'll talk about evolving R. We'll talk about dynamic risk position sizing and how I can really add to those trades. And the best traders have this ability to keep adding to their winning trades. So I'm going to cover that over the coming weeks in further details. In terms of trading resources around risk management, for me, I think like I've stated previously, the chat for traders, I would highly recommend that you all listen to the best of risk management part 1, the best of risk management part 2. And then for me, one of the very early videos that I ever watched is a special shout out to Crypto Cred, which was the technical analysis series around risk management. And it's from here that I picked up the evolving R concept, which is created by Tom Dante, and I've incorporated that now into my own trading routine. All right, so thank you once again everybody for tuning into this video. Sincere apologies, it's taken much longer to get this out due to the fact that I've been moving locations. I've finally almost settled down, so we will be looking to pick up the pace of the mentorship and hopefully get this all wrapped up by the end of May. Thank you once again. I'll catch you on the next video.